Our next guest's take is basically it's time for the Fed to be proactive and leading. Let's bring in Jim Caron, the Global Fixed Income Portfolio Manager at Morgan Stanley. Jim, welcome. Great to have you here. What do you mean it's not? It is the central bank of the world, isn't it? So isn't it by default the leading central bank?
It's supposed to be. So let's put what the ECB did today into context, right? So they're talking about 20 billion, of QE per month until they start hiking rates again. If you look at the forward markets, what that tells you is that the ECB is not expected to hike for another 6 years. So if you do $20 billion a month for
Sounds
6
like $1 trillion
years,
or more.
it's over $1 trillion of quantitative easing. What is the Fed doing? They're still talking about the Phillips curve. They can't quite decide in terms of what they want to do with rates. Do they cut 25? Do they not? And I think this is what I mean about the Fed is actually lagging behind. The more the Fed lags, the more the market will price in that they're going to have to do more later. Because I understand the topics that were being discussed here. You know, CPI is higher, so why do we care? We care because the Fed is looking at core PCE. Core PCE is only at 1.7%. If you start, and that's below their target of 2%. If you start to embed disinflationary or deflationary expectations into the economy, you end up with a Japan-like situation, and they've been trying to dig themselves out of that hole for over 25 years. So I think the Fed is trying very, very hard not to get there. The ECB has certainly got the message, and they're doing it very proactively. The more the ECB does, that means the dollar will probably get stronger because interest rate differentials, rates will go down in Europe, and rates won't necessarily go down so much in the U.S. I do think this puts pressure on the Fed to do more.
So what does the Fed need to do to be proactive?
Well, I think that there are two criteria that will define success for them. They need to steepen the yield curve. They need to weaken the dollar. Now, that probably comes with a rate cut. How aggressive and how much becomes the next question. So I would expect the Fed to cut 2 more times this year and probably at least another 2 times going into next year. So I would expect about 100 basis points more of cuts. Now, if we start, and that's what the market is pricing in right now. If the Fed actually does deliver that, and we are starting to get some recovery in the economic data, then what the Fed is going to start to show us is that now they're starting to get ahead of the curve, they're starting to become more proactive. They're going to rebuild inflation expectation, rebuild term premium into the curve, re-steepen the yield curve. And I think on a relative basis, when we look at the dollar relative to other currencies, the dollar may actually start to weaken or at least not rally as much. And I think that's the key.
Jim, 10-year yields peaked almost a year ago, 3.26. So
right.
We're anniversarying a year of lower interest rates. Does the stimulative effect to that start to show up in the data?
I mean, it does, but also the fiscal benefits from the tax cuts that we've had for a while is also starting to fade. So yes, you are getting a decline in interest rates, which should start to help, but also the fiscal stimulus that we had from the tax cuts, from 2 years ago, year and a half ago, is also starting to fade. What's more important, I think, is that when we look at the forward, aspects of the economy, when we look at trade, when we look at China, what is the potential for weakness? Now, I agree with what's being said where, does the Fed really have to be aggressive in this economy? Look at where the stock market is. I think that's a little bit the wrong question. I think the question is how much insurance does the Fed need to take out so that the U.S. economy doesn't turn into a Japanese-like economy where they have perpetual disinflation and deflation? If it were me, the risk reward is, let's do a little bit too much. If the stock market goes up a lot, we know how to fix that. We can actually hike rates pretty aggressively and we'll turn that around fast, but we can't fix it the other way if inflation expectations go down for too long.
But Jim, you can't fix it the other way once you've gone too far as well. So there's this fear that we have so many bullets, et cetera. And I think it's first of all, very interesting, and it's not a thought that's out there, but the fact that the ECB could be leading the Fed here is an extraordinary concept because it's the tail on the dog. The ECB has always been that tail.
Right. And I understand the worries of bubbles and inflation expectations. The thing is, I don't see an inflation problem in the world. And if I did, then I would say the Fed needs to tread very, very carefully. As far as bubbles go, look, I think bonds are acting perfectly reasonable relative to what central banks are doing. I think, now I'm not an equity analyst and I don't invest in equities, but I would say that equity markets are probably reacting properly relative to low interest rates. So I don't necessarily see things as frothy and as a bubble. I don't see a lot of leverage that's a problem. Now, corporate leverage is high, but what we also have to remember is that the term of that leverage, so in other words, many corporations have termed out their debt. They've refinanced for longer term debt, and their cost of borrowing is really, really low. So even though leverage is high, and people like to highlight that, the cost of servicing it exactly is really, really low. So I don't see this as a pressure point. So this, to me, gives the Fed a lot of room to be very accommodative, at least try to keep up a little bit with the ECB. And if it turns out that the ECB is doing the wrong thing right now, the Fed can reverse and they can go the other way. Easily fixed.
So, Jim, of all the asset classes out there, you don't necessarily see frothiness in equities. Commodities are certainly not frothy, but the bond market might be called frothy. Other people have called it a bubble. You're a fixed income portfolio manager. Do you think it's a bubble? And if so, how are you handling that?
I don't think it's a bubble. And I do think that there are really good pockets of opportunities, and particularly in emerging market local bonds, so local currency EM debt. A lot of these bond markets really haven't rallied relative to, say, what the equity markets are doing or even what the investment grade markets are doing. They're lagging behind. And what we want to do is we want to find pockets of places that really haven't participated in this. Now, many emerging markets, they have steep yield curves. They have higher interest rates. Their central banks have plenty of scope to cut rates. They have very positive real interest rates. That's where the money is going to start to gravitate towards. One prerequisite, you have to have some semblance of calm between the U.S. and China. If the U.S. and China are continuing to battle, EM is going to sit in the back seat. If that calms down, and I think it will for the remaining part of the year and maybe even a little bit into next year, then the money is going to start to chase the assets that haven't appreciated yet. So emerging markets is one of those places, and I'll give you another outlier pick. I would say in the high yield space, some of the energy sector, which has absolutely gotten destroyed. You get some calm, energy starts to do a lot better. Plus, if people do start to move back into high yield, for example, they'll buy the ETFs. By default, they're buying the energy sector, and they're going to take that sector higher. That's a contrarian call right now. It's risky, but I think it could be worthwhile.
Jim, great to see you. Thank you.
Thank you.
Caron, Morgan Stanley. Guy, what do you think?
Makes great points. Listen, it's hard for me to argue that he's not 100% correct. I guess my point is this. Just because everybody else is doing it doesn't mean you should do it. Quick example. The big thing now is you hold your kid back for a year, you give him or her competitive advantages. But if everybody does that, you're right back at square one. So at what point does that stop?
And you're shaving in second grade.
And you know what? We're not that far from that. So I guess my point is, if all the central banks are doing it, we all get there, then at what point is it just madness and it has to stop? Almost by definition, I think, there has to be some negative ramifications for the recklessness of global central banks. Just my opinion.
The challenge of targeting a steeper yield curve also is, does the Fed actually have control over the yield curve with a blunt instrument like cutting rates?
Right, exactly. I mean, the one thing they do have is their balance sheet, where they actually can do like a reverse operation twist. I've talked about that before. But basically, the idea is they have more control over the yield curve than they have in the past. The one thing I would say, the call on high yield is kind of interesting, particularly for U.S. bank stocks, because one thing we always get concerned about when oil goes down so much is how much exposure do U.S. banks have to the oil patch. So if that's going to get better, that actually might put a bid under bank stocks as well.